Christmas without you. I'll be so blue just thinking about you. Oh, hold on. Wrong show. Oh, I was auditioning for America's Got Talent. Hello, Warriors. Everyone doing okay? ECB Day? Welcome, viewers from investing.com. We have the ECB. It's going to be the feature of the day. So not just their announcement, and I don't know if they've made it already, but used to have to really pay attention to the press conference with Draghi. Dollar's trying to hold, euro's mid-range. You know, it's anyone's guess which way that it's going to come out of here. Perfect situation for volatility spreads where you buy calls and puts and look for this compression of the range to resolve itself. One side of the trade compensates for the other side of the trade. Everyone with me? Okay, so the dollar right here, just another little pullback after it tried to break out early in the week with the down day yesterday. Still my contention, it's got to take out the buy stops above these levels. What would change it? You'll know we have something changing back under 96.80, even more evidence at 96.40, and any closes under 96. I think you could start looking for the dollar to pull back. Here's 96.50, which it held right to the tick. Underneath it, I think you could be looking for 94 handles. Above it, the range is about 150 points here. So if we get a breakout over 7.5, that measures 99. Some guys that I follow have interviewed, have been talking about 99.20-ish or so, extreme, maybe 102. So a pretty important day for the markets. While you have a little yen strength, and that's, you know, you would think that's going to happen. It's been strong with the dollar moving sideways in the last week or so. So it's trying to come out of here. I'm actually taking a little contrarian stance on it, not because I'm bearish, but because I think that we're going to get, even if we take out these highs, some type of fib retrace where I'd like to get long down here. So we'll see how that works out. And if the yen's going to be good and just blow off from here, then the precious metal correction should continue. We have a great guest today. Stick around for Larry Benedict at Op Traders 1. Larry was written about by Market Wizards author Jack Schwager in his second book of Market Wizards 2. So if the yen continues, you're going to see the gold correction continue too, maybe back down towards 1235 to 1230-ish. That's going to be an important thing for a continuation of the rally. You know, really shouldn't see it starting to close much under 36, or, you know, could start looking like a false breakout if you just take it from prior resistance levels. But support all the way down to 24. Silver is outperforming it. So gold silver ratio seems to be turning here. Steve has featured it. A little stronger looking chart, although you're getting a reversal day there too, with some divergence. It's above 78.6. You would think they'd want to target these levels, but we'll see. The dollar is the linchpin and the key to what the whole global financial system spins around. Good morning, Blake Morrow. Are you spinning around the fulcrum of the dollar wheel this morning?
Hey, good morning, Coach. Yeah,
How are
yeah, good. I'm a little irritated that the market just seems trapped right now, and the ECB meeting, as you pointed out, they used to be a really, kind of a big event,
Yeah.
and they have been really
anticlimactic.
Yes, very much so as of late, and You know, I'm a little bummed if we don't get some sort of volatility coming out of this market. It's hard to find things to do, and it's a tad bit irritating. And you know, the euro. I mean,
You were long yesterday in the euro, Blake. A nice pop off that bottom triangle line.
Yeah, I mean, I play. Thank you. I mean, I played a little, little bit of it, but I mean, it's not. I'm yearning for a 200 pip move here, and we're just not getting it. So a couple things that I'm looking at. First of all, you can see that the euro dollar's inside this wedge. We got a little or triangle. We talked about triangles being more terminal than anything if they're in the direction of the trend, and that would be like the euro dollar making one last move lower to 112. I was hoping that would come to fruition. Problem with, if you look at the dollar index and you go over to the daily chart, one of the issues that the dollar index has, let me grab this. I'll just grab this little oval here, and let me tighten that up just a bit, and let me do that. So if you're a non-ForexAnalytix subscriber, can you guys tell me, again, a non-ForexAnalytix subscriber, tell me what we've got there with the candlestick. You guys that are listening in, what do we got? Anybody?
Going once. Okay, a little education is going to be coming from Blake. And write it down because you'll forget it tomorrow. Steve doesn't know.
Abdul, aren't you a ForexAnalytix subscriber? Aren't you? Yeah, but I said for non-ForexAnalytix subscribers.
He couldn't help it. It's like when you're in a classroom as a kid, you're raising your hand, going, "Oh, call on me."
yeah, me. Yeah. So what I was hoping for is I was hoping for a move up here, and then hit the 618 and come down. But then this chart pattern or this candlestick pattern here is dark cloud cover. So, dark cloud cover is when you have like, two or more white bars, and then the red bar, comes underneath the white bar. And so you got dark cloud cover that, and the reason why this is irritating to me, it's because this is going to prohibit. Well, I mean, it's not guaranteed to, obviously, but this is one of the things that's kind of standing in the way, in my opinion, of the dollar index hitting new highs, or getting a new trend high. And you can see I have an alert set up here because I want to be notified if we get to the 618 because I want to short the dollar. And now we got this dollar, dark cloud cover on the daily. It should make its way to the downside. That doesn't necessarily mean we're going to break down either. That doesn't mean this. That means that we could just come down to the lower end of this triangle too, and then we're going to have to do something like this and go, okay, I'm going to be irritated for more days, and so I'm not sitting here looking at the dollar saying, okay, here we're going to break down today, which we could. I mean, remember, it is the ECB meeting, and Draghi is going to speak, and remember the ECB has now halted bond purchases, and they're keeping rates unchanged, and now they're going to start discussing
Deutsche Bank. They're buying Deutsche Bank instead.
Yeah, well, they will be. We're going to see how much of discussions they are having, or how close they are to possibly raising rates in the future. But
do you remember George Carlin, Blake? Because when
yes,
you're talking about dark cloud cover, it reminded me of his routine as a weatherman. The forecast for tonight is dark, turning lighter towards the morning.
Yeah, George Carlin.
Yeah.
Anyway, I'm just sitting here looking at the dollar saying, I want an upside breakout. The daily candle, kind of prohibits that. So, chances of us getting a new break to highs, to trend highs today is going to be a little harder. But yet, is this a bearish enough, signal to tell me to, you know, short, you know, dollars or go long the euro and expect a new high. I don't know about that either. So I'm just kind of, you know, irritated. And then you know,
hard to wait.
Yeah, and then the one comment that, and this is from Bloomberg here. This is the one comment that put a bid in the euro when, because the euro initially, here, let me move that really fast. So the euro initially, let's go over to the euro here. It sold off, you know, like it spiked down, then it spiked back up because, you know, algos read this headline: will reinvest past date of first interest rate increase. What? They said interest rate increase, and then the algos went and bought that up, and then the market, you know, came to its senses and said, whoa, wait a second, you know, is that, you know, just because the algos went and bought it, you know, doesn't necessarily mean that interest rate increase is happening anytime soon. Then they slam the euro back down, and then here we are, just kind of mid-range. So that was all algo buying off that one headline, and then it reversed, you know, and then, you know, came right back down. Anyway, unless the ECB really sends the message to the market that interest rate hikes are coming, you know, here sooner rather than later, then, you know, chances are we're probably just, you know, range bound, and that's realistically what we're looking at, is just a range bound market, and we're trapped, and it really sucks, and I'm a little bummed out about it. Now, you know, let's talk a little bit about the cable. So the cable rallied right to now Prime Minister May, she survived the no contest vote. So if you think about what the cable is doing, is we're right back to where we started the week. Actually, we're a little bit lower because really all the issues still are faced. Okay, so you have a prime minister that can't push her agenda, or, you know, the Brexit deal that she has currently through Parliament. And even though she survived the no confidence vote, the number of supporters that she has is not as strong as she would have liked. So therefore, she's still going to struggle trying to push, and probably not going to succeed to push her Brexit plan through. So therefore, you have a pound that's actually a little bit lower on the week, despite her surviving the no confidence vote. The only way the pound is breaking higher from here, and I'm not saying it can't, I'm just saying the only way it's going to break higher from here is if you see a real big change in events as far as support for her Brexit plan, or you get the euro dollar that actually breaks higher and we start, you know, trading above 114.50. Then by default, the pound's going to get dragged up just with dollar weakness all the way around, and then we'll end up putting in a false breakdown, and then technically it'll end up squeezing some traders. But as it stands right now, if the euro is just going to be sideways, the better trade is probably just to short the cable here. Now, I'm not short the cable. I'm just saying that, you know, that's probably the better setup, is just say, okay, well, the euro's not going anywhere. So if you're in the camp that you're thinking there's no way the euro's breaking out and the dollar is going so much higher, you know, the dollar index is going to 100 again and the euro is going back down to 110. If that's your idea and that's your thought process, which I'm not going to be here to tell you you're right or wrong. I'm just saying, if that's your thought process, you're probably a good short is the cable. Now, with that being said, if the euro does rally and it does break 114, then, you know, you're going to have a pound that starts squeezing, and then technically you got an issue here, because then you're going to end up having a false breakdown in the pound, and then you'll end up having a bullish hammer on the weekly chart, and then you don't want to be short. You know what I mean? So, but does that help you right at this moment in time? No. And I look at the charts right now and I go, what the hell am I going to do? You know, there's not a whole lot to do. Now, that doesn't mean in 15 minutes, once Mario Draghi starts speaking, that there isn't going to be something to do. I'm hoping to God that he says something that spurs like some massive volatility, like Greece is broken, Italy is broken, Europe is broken, and then the euro craps the bed and sees 110. Or Greece is fixed, Italy's fixed, France is going to get better, and Europe is fixed, and I'll do whatever it takes, and then the euro rallies to 117, and then I'd be happy. Unfortunately, neither one of those things are probably going to happen today. So, you know, I'm just trying to prepare for the worst here. You know, you look at the Aussie. What are you going to do with that? I mean, look at these candles. You're trying to get a bullish bounce. but look at all these long candles, wicks, you know, so in all actuality, we might have a little bear flag pattern. You know, I wouldn't want to get long the Aussie right now. I mean, you just look at that and it looks gross. You know, why would I want to get long that thing right now? It looks like, you know, it's a, you know, pennant. Then you have the Kiwi. It's not doing anything. You have the Swissy. The Swissy really stinks to the high heavens. Then you got you know, the Canadian, which is stuck in this uptrend, but it's, you know, floundering with a possible double top. Nothing to do here. And you got the Swedish krona, not doing anything. You got the peso that's still hovering above 20, but it's not breaking down yet. You got the Norwegian krona that's, we thought we were going to get a breakdown, held the 38% retracement, bounced right back up, and blah, here we are. Then you got the dollar yen that's still range bound. And frankly, the dollar yen, if there's anything, and oh, I forgot to mention this to you. I read a statistic 2 days ago, and I shared it with the chat room yesterday. If you bought S&Ps on December 11th and you sold it December 21st, you'd made money every year in the last 15 years. You want to talk about Santa Claus rally statistic? Again, I shared it in the chat room yesterday. Does that mean that year 16 is going to be the same? No, but I'm just saying that, you know, seasonality has played out the last 15 years. Now, why is that important? Well, if the S&P, let's say for argument's sake, we are range bound, which I think we are, which if you read the S&P analysis every day on ForexAnalytix, and you can go back, you know, this is December 6th. S&P held long-term trend line as a push stops below the trend line and gave an intraday V-shaped recovery. As long as the 26.25 level holds, the risk of bouncing in the coming sessions. S&P closed the week right at the triangle support previous lows. We believe it'll break lower from here, blah, blah, blah. Or watch 2690 as resistance. S&P seems as maybe range bound. This is December 10th, beginning of the week. Range bound between 2600 and 2816 level near term, as the recent low may have been false breakdown with divergent RSI. Here we are just basically range bound. And if the S&P, by the end of the year, it makes its way back to 2700, 2725, or, December 21st, the question is that I have to ask is, where's the dollar yen going to be? Because the dollar yen is holding up. The dollar yen is not going down. And so if the S&P, rallies, 50 points from here, my guess is that, the dollar yen is going to be trading up here at 114, 50, 60, 70. And then the fact of the matter is, this has held us up for 2 years, basically all of 2017. So you can go, well, a year and a half really. So May of 2017 to right now, we've held up at 114, 70. But if I was short the dollar yen, if I was going to short the dollar yen, I don't think I'd want to be short the dollar yen if the S&P does, matter of fact, play into seasonality. So, and the dollar yen could very easily break to the upside. The reason why I'm pointing this out is because if the euro dollar does break through 114 and change today, let's just say we get, God answers our prayers and gives us some volatility. All right. And let's say the euro rallies and the dollar yen holds up. Well, then the euro yen, very similar type of triangle formation, we could break the 200-day moving average, which comes up here at 129.70, and then we can make our way back up towards 131, maybe 132. These are all things that, as much as I'm hoping something will move, this is at least a near-term development that may transpire if we could get a little bit of a euro dollar rally and a little bit of a risk rally. And so that's kind of what I'm paying attention to right now. And if you think that my analysis is downbeat, it kind of is, in the sense that I'm I'm a little bummed out that we're just seeing a lot of this consolidation. But remember, consolidations don't last forever, and also consolidations tighten, and eventually, whether it's today, whether it's Monday or Tuesday, or maybe even Wednesday of next week, regardless, we will break, and we're going to break one way or the other. And you can see the euro dollar. I mean, the euro dollar is, if it's not today, we've got maybe a couple more days, and then, we're going to see probably a pretty good breakout. Like I said, it could be today. I'm hoping for today, but a breakout is brewing, and when it comes, you guys got to be ready to pounce. So Bob says,
easier for algos to do it too, because Blake, you're a veteran. These last couple weeks of the year, everyone leaves. They're on their vacation. Kind of like before Labor Day.
Yeah.
We really thin out until the beginning of next year.
Oh, the market's really going to start to thin out in the next week. Like if you look at the calendar. So like, for example, I'm going to be out of town mid next week. I'm going out of town mid next week. I'm flying to New York to go to my Christmas or holiday party. It's not just a Christmas party; it's a holiday party because we have some Jewish guys in the office. So it's not just.
You could say it. You could say it. Man.
No, I'm just saying that. I live
in Blake. Here, I'll teach you a few words.
I live in North Scottsdale, and my son practices, at the Jewish Community Center, the JCC, and it's like half of my neighbors are Jewish. I mean, it's just I'm in a big Jewish community here, where I live. But I mean, we're going to our holiday party, and then you think about that. Most holiday parties are probably taking place 19th, 20th, 21st. Ours is going to be, at the end of the week. So you got, holiday parties, and then you got Christmas week. So it's going to really start to thin out at the end of next week. And so the chances of us getting that volatility, this last burst of volatility, is you're talking from now to Wednesday. And then after that, things do thin out. And when the market thins out, as a veteran, I'm going to tell you guys, and when I say not a Marine Corps veteran, which I am, but as a market veteran of 20 some odd years, almost 25 years.
Ooh, you're almost as old as me.
No, I'll never catch you.
I forgot, Blake. No one's that old.
I will never be a dinosaur. Just kidding. Just joking with you. But
you're a T-Rex.
As the markets, as we get towards the lack of liquidity issues, I'll just tell you last year, if you guys don't remember, the Aussie, for no reason, and you can look in retrospect, it was just all flow. No reason at the end of the year, the Aussie went from, I'm trying to draw this out here,
Oh, wow.
The end of the year, the Aussie was just ripping. I mean, look, December 18th, here we go. It was December 15th. Right here, we just started ripping for no reason, all the way into middle of January, and then we pooped the bed. It was. I mean, but it's crazy. Once the flows start, don't get in the way. And this is probably a pretty good, indication here. You see the dollar index, really tight. Yeah. If the dollar index breaks higher going into the end of the year, you probably, and especially if we break that 618, let's just say, if we break 618, you probably just want to just get long the dollar and stay long the dollar. Flip side is if we break below here, we're probably going to go see the 200-day moving average by the end of the year. So if we break below that support, don't get in the way. Get out of the way, because now you're going to get flows that are probably going to complement this break out or break down. And so just stand aside, despite what your macro better instincts may be telling you, whether it's an upside breakout or a downside breakout. Just get out of the way, because once the flows start and there's just lack of liquidity, I cannot tell you the countless
one-way streets,
holiday, Christmas or New Year's, Hanukkah, holiday season. It is just a one-way freight train going in one direction, and and I've faded them. Believe me, I've done the rookie mistake and faded them, and I've gotten run over every single time. So, and yeah, Nitish brought up the FOMC is on the 19th, which I'll be traveling that day, but and that is the FOMC. And post FOMC, going into Thursday, after Thursday, yeah, forget about it. Just whatever direction we're going, just get on the train or stand out of the stand to the side. You know what I mean? So anyway, best advice I can give you. I got to go because we have the ECB meeting coming up. If you guys haven't done so already, let me just mention this really fast. Forest Park FX. If you are a European trader and you do not use ForexAnalytix, or you're an Asian trader, or you're just not in the United States, use the reimbursement program so you can get ForexAnalytix for free. Use one of these brokers down here, sign up with Forest Park FX, then you can use ForexAnalytix for free. You can help, well, at least reimburse you for part of your, depending on your trading. If you're a US-based trader and you want to get a cashback rebate, talk to Forest Park FX. I don't know why you wouldn't do that. So you can contact them on Skype or this email, brokers at forexanalytix.com. It's right on our page where it says reimbursement program. I'll put in a link. Yeah, talk to them because I don't know why you wouldn't, and be part of our community. So with that being said, Steve, it's yours. It's all yours. Dale, thank you very much for having me. Stelios, I'm sure you're here. Good morning. And Steve, good morning.
Blake.
All right.
Good morning,
Blake. Good hunting, Blake.
Thank you, and good luck at the ECB, guys. And Steve and Stelios will be here covering it live.
Absolutely. And I do think that we have a decent chance of seeing finally some kind of a breakout. Obviously, the euro is waiting. I mean, that's why we've been coiling here. Obviously, the euro is waiting for Draghi to give some kind of a direction. Now, to be perfectly honest, Draghi has surprised on the dovish side lately. Right, Stelio? I mean, he's neutral to dovish, actually.
Yeah, marginally, but yes.
Yeah.
Given what's been happening in Italy and France, I've said this on the chat room, it's very difficult to envisage him being really hawkish. At least not now. Maybe with the new year, if things calm down a bit, maybe. But really now is probably not the time to be too hawkish, my humble opinion.
Also, on the other hand, Stelio, I don't know how much of a role it plays, but it definitely plays some role. We know that Draghi's term is nearly over, so probably that's an extra reason for him not to want to stir things up too much, right? I mean, so far he's had a successful tenure at the head of the European Central Bank, and probably
Steve. Okay.
No,
all right. Kind of like Bernanke left the dirty work. Yellen, the dirty work. God, I'm in a time machine for Paul.
Yeah, but remember what Trichet did, right? He left, and just before leaving, he hiked rates for really no apparent reason, and they had to unwind that hike afterwards. Remember that? That was quite fun. Yeah, but like you said, he has been slightly dovish in the past, and I don't see a reason why he should be hawkish. Let's put it that way. And speaking of the ECB, we have to mention that the Italians seem to be caving, and they actually agreed on 2.04%. I have no idea how they came up with that number of the deficit, but they were going for 2.4. The ECB was going 2%. The Europeans wanted 2%, so they said, okay, 2.04. This is what they've said they will do. Now let's see what they will actually do, and I will take the over on that number any day of the week.
Same here.
So yeah, that's what's happened. That has actually brought a bid to Italian government bonds. The spread with Germany is tightening, and that's giving a little bit of a boost to the euro. But other than that, really, we're just waiting for the presser, which is starting in about a minute, isn't it? So I'm gonna be watching that. Any headlines? I'm gonna be
please do, so I can start covering things. Although not much has changed, I do believe that Draghi's initial statement and perhaps afterwards the Q&A are going to actually give us some kind of a push one way or the other. And the vast majority, dollar and the vast majority of the dollar pairs are also seem to be waiting, for Draghi to be out of the way so they can resume whatever they were doing. That's one of the reasons that I would, clearly from a technical perspective, if I had to do something here, if I was, forced to trade this, I would still really want to see, for example, like some kind of a dovish surprise, or anyhow, Draghi being neutral to slightly dovish, and perhaps the market just resuming where it left from and seeing one more push higher for the dollar. As I've said, there are two levels of interest. Both of them are confluence of resistances. One of them is at 97.90 roughly. It's a 61.8% of the move lower. It's also a fib extension of this last correction lower. And the other one is at 99, where we have the 161.8% extension of this corrective move lower.
I like that one.
Yeah, I like it as well, Coach. It's also a previous horizontal support resistance area and an area of congestion. As you see, we also have these ascending channels resistance there. So personally, I would really, really like to see, Draghi, for any reason, create some euro weakness, and I would then be looking actively for opportunities to start shorting dollars in the following days. Yes.
Steve, I think on the weekly, that level up there, 99.100, it's 78.6 back from the 104 high to the 88.5 low.
Yes,
on the weekly.
Absolutely. So, this is what I'm looking for, but, nobody can predict in advance what's going to happen. But just assuming, and that's something that I always try to keep in mind, right? Just assuming that we stalled here in expectation of what's going to happen with ECB, what was the previous trend? If the market was not waiting for the ECB, what was the market doing prior to this? The market was actually slowly drifting lower, right? So the reason I'm saying that is that I believe that even if, let's say, Draghi comes out exactly as expected, there is a decent chance that we will continue drifting lower just because that's going to be out of the way. So the market will be able to resume. By the way, Draghi has started speaking. So Stelio, you can interrupt me at any given point, to give me his comments. Let's see. So I'm focusing here on the euro. Actually, let's go down to a 4-hour chart as well. Let's go here to the euro USD on the 4-hour time frame and see what it's doing. So far, nothing.
No, he's confirming that they're going to be looking at raising rates after the summer. We knew that already.
Which tells us nothing new. Yeah, exactly.
Okay, if anything noteworthy comes in, I'm gonna let you know.
So far, I've been listening as well. So far, nothing really. We intend to continue investing in full the principal payments from maturing securities purchased under the APP for an extended period of time past the date when we start raising the key ECB interest rates, and in any case for as long as necessary. So in essence, what he has said is that they're not looking in the near future of reducing the balance sheet. So if I may add a comment to that, they're never looking into reducing the balance sheet, because I don't know whether...
He just said, sorry to interrupt, incoming information has been weaker than expected.
That's true, actually. That's true, globally. That's actually true. By the way, we also got initial jobless claims. What is this? Is it an...
Jobless claims was better than expected, if that's what you're looking at.
206 versus 226. Yeah.
We also had import and export price index, and they were quite a bit worse than expected.
Okay, so far, really nothing has been moving. Nothing. We've seen a little jump from the euro, but nothing really noteworthy.
Draghi saying he sees gradually rising inflation pressures. Again, it's not something new. Significant monetary stimulus still necessary.
Okay, that's quite a dovish comment, but nothing out of the ordinary as expected.
No, I'm going to keep monitoring, and if anything big comes up, I mean, I doubt it.
The rest of the data that I see continuous claim comes more or less, you know, as expected. I mean, marginally higher, not even worth mentioning. So data really not going to be moving the market. Okay, let's see. I mean, so far the market is extremely muted because, as you said, Draghi has been sticking to what has been said over and over again. So no surprise, both positive or negative. Okay, I'm going to start going through analysis, Stelio, and please let us know if something that, you know, moves the euro comes out of his mouth. Although so far he has made them, you know, an effort, and he has succeeded in actually, you know, saying nothing.
He's saying that there's significant stimulus still needed to sustain inflation, and they're ready to adjust all instruments if needed. You know, this is just the same case.
Yeah.
It's a bit of a two-way.
Dovish, but as dovish as expected. Nothing more, nothing less. Yeah.
Okay.
With a little exception, which was also not, you know, weird, that he said that some of the data have been weakening, which is something that the market already knows, and that's not only the case for the eurozone, it's also the case for the US and you know, the vast majority of the developed economies. By the way, we see now the euro paring back earlier gains, but in all actuality, nothing has been moving. Anyhow, okay, back to analysis, and let's see if something happens. Okay, what I was saying earlier in the chat room, today in the chat room is the following. First of all, I said several days ago that I believe that if we have a jump from here, it's probably not going to make it once again back towards 28.12. So I'm looking to be short, you know, at lower levels. And the fact that so far today we had, so far up until today, yesterday and the day before yesterday to be exact, we had 3 attempts from the market to actually rally higher, but both of those attempts later on the day found strong resistance and strong selling pressure. Tells me a lot. I mean, this zone that we've indicated, the 2690 zone, which extends, let's say, from 2685 to 2695, seems to be doing the work so far. And as you see, going back, I mean, it has been a strong area of resistance and support. And I do think that the S&P and, of course, you know, every other index is in danger of failing without managing to produce much of a rally, despite being, you know, in the period that the market expects the Santa Claus rally. Doesn't seem very likely that we're getting that this year, and that tells me a lot. Let's go to the Dow Jones. As you see, the Dow Jones is barely holding this triangle on a daily closing basis. Yesterday's price action, very bearish. It almost closed unchanged after being up on the day. The day before yesterday's price action, the fact that it gapped higher and then actually managed to close lower than the previous open, very bearish as well. Let's go to the Nasdaq. Nasdaq has been behaving better during the past 3-4 days, but that still doesn't change the fact that, you know, on average, since we found the top, the this index has been leading the rest of the indexes lower. And I remind you that theoretically speaking, that was the steam engine of the rally that we've been seeing during at least the past couple of years. And, you know,
Steve, can I just interrupt for a second?
At any given point, you can interrupt, yes.
Yeah. He said the balance of risk is moving to the downside, and he's they're reducing their forecasts for GDP to just slightly lower.
Yeah, and here is the euro actually now reacting to that. Yep. Yeah, I see it on Bloomberg as well. Breaking, Draghi says the balance of risk is moving to the downside. Yep. And he's actually right. Let me say here, for example, many people haven't realized, and people that are listening to us every single day, they know that I've been saying for multiple months that I see a huge risk of a recession coming within the next 1.5 years. When I started saying that, it was like half a year ago. And now we have banks like JP Morgan that are forecasting like a 60-70% chance of a recession within the next 2 years. They are the same banks that were forecasting, almost zero chance of a recession 6 months ago. So let me add to this that I believe that they're wrong again. They're wrong again on the timing. I don't believe that the economy is going to make it to 2020. I do believe that the chances, they are right about the chances of a recession, but I think that the time horizon they're giving to 2020 is too extended. I agree more or less with the chances, but I believe that the time horizon is quite shorter. I believe that, within the next year, the chances of a recession are, in my opinion, at least like 60-70% at the very least. So we've been seeing the data point to that as well. The fact that this has been one of the most prolonged business cycles, in combination with the fact that the only reason we've had with such a weak global economy and such a huge debt issue globally, such a prolonged recovery, is the fact that the vast majority, if not all the major central banks, are actually still have negative real rates, because I remind you that real rates are the nominal rates minus inflation. So even if we take into account the reported inflation rate, rates are still negative. So for example, the Fed is now trying to persuade us that the neutral rate for this economy is at zero real rates, which means that still absolutely no incentive for savings. Whoever knows a little bit of economics needs to understand that savings is like one of the most critical financial measures for future strength, because investment comes from savings, right? And there is a given capacity that you can keep borrowing and borrowing until some point this is unsustainable, because we've already been past the point that this is a Ponzi scheme. I mean, the US had even recognized in the past that in essence we're running a Ponzi scheme. I remind you, when we had that whole crisis with the debt ceiling, the US in essence said that if we're not allowed to borrow more, then we will have to default. So this is an admission that the only way that you can sustain the economy at the moment is not by repaying the debt ever, but it's by borrowing more and more into the future. So that can't go on forever. Anyhow, we are seeing some euro weakness, but that hasn't been enough for this symmetrical triangle to break. I do believe that the chances, I said it before, we even had Draghi speaking, I do believe that the chances are, since we've already heard enough from Draghi to know that he's not going to surprise to the hawky side, which we didn't expect either way, I do believe that there are decent chances that we're going to see later on the day some dollar strength coming through. But we have to first see these ranges being broken for confirmation, because until then all that is speculation, just playing with statistics and experience. But that doesn't mean you're always right. It means that you might be right more often than not, and nothing more than that. Now let's see what the metals are doing. The metals have been more or less consolidating. I mean, gold has been consolidating. Silver has been pushing higher. So silver yesterday produced a very nice outside white candle, which is a bullish development. It has also broken finally above this descending trend line resistance, which is also a bullish development. But as I've said multiple times, if you want confirmation, then we need to see this rectangle break to the upside. Then we will have a measured target. The measured target is going to be the height of the rectangle extended, which more or less points to a rebound towards the $16 area, towards the 61.8%. So if that happens, then I'm going to be seriously interested in gaining some exposure. But until that happens, we have to respect the fact that the move higher in gold, even if it appreciates a little bit more than it has already done, and the consolidation in silver can easily end up getting resolved to the downside. Now, platinum has already produced what I expect that gold is going to do. I mean, it did recover. It did lead actually the metals recovery higher, and in my opinion, it might also be pointing lower because it was the first one that actually made the move. Palladium is still very well beat, but I would be very, very careful here because we're testing the 141.4 fib extension from the corrective move, and even if we make it above there, we're going to be finding some confluence of resistances here with the ascending channel and the 161.8% extension. So I do think
Steve, can I just interrupt for 1 second?
Absolutely.
Not for Draghi, but just because you're speaking about Palladium, I was reading this piece a couple of days ago, which was talking about short-term lease rates for Palladium, the actual physical thing. And they were something like 15, 20, 25%. So that shows a huge shortage of the actual physical. Yes,
commodity,
because you have all these financial instruments which are theoretically backed by actual Palladium, and you have to deliver futures, forwards that expire and all that, and 1 and 2 and 3 month lease rates are ridiculously high, and that shows that there's a huge shortage, and just something very interesting to see. And I'm guessing this is one of the reasons.
So I'm guessing that the market is in. I'm guessing, Stelio, that the market is in backwardation.
Backwardation, yes, it is.
That's exactly what I was going to ask you.
Yeah. It makes sense. The market then is in backwardation. For those that don't know, backwardation is when it's actually cheaper to buy something with delivery in the future than it's for a prompt delivery, because that shows that there is a shortage and the market expects that shortage might be resolved later on. That's why it prices in like the possibility of cheaper prices going forward, and this is a very usual signal. You can see it in the vast majority of commodity markets happening on occasion. I mean, metals, energy, etc., etc. So, Stelio, you're saying that there is a real demand-supply issue at play here, right?
It looks like it. I mean, these rates show that. So, it looks like there is.
Yeah. And we've said multiple times that the move higher was clearly impulsive. We can see it here. The move lower was clearly corrective. I tried multiple times to buy this damn metal, and I'm really pissed because every single time I placed an order hoping for a pullback, never got triggered, never. So although I expected this move higher, I made the mistake of not buying the breakout and expecting then some type of a pullback to buy it at a better price, and never got triggered. So I'm pissed because I saw this coming, but I never managed to to get on in it. Yeah,
there's a Pinkertism, buddy. Don't expect don't expect at the craps table.
At the craps table, yeah, very true, very true.
You play craps? I mean, you're a gambler.
No.
Okay.
I'm not a I'm not a gambler, and
okay. Well, you're a sports bettor. What do you call that?
I'm not a gambler. I never had a gambling mentality at all. Even though I started at a very young age.
That's what you tell your wife, man. Don't tell us that.
Yeah, come on.
even though I started at a very...
All right, let's use an adjective. You're a speculator, which is a gentleman way of saying gambler, don't you think?
Not really, because if you use rules and statistics, it's not gambling. You know what I mean? Because
card counters do that play blackjack.
Oh, I'm not saying that everybody
they use rules, and they're gamblers.
I'm not saying that everybody that plays card is.
All right, I'll see you at the GA meeting next Wednesday. We'll end it. All right. All right, buddy.
Copper, by the way, once again in the middle of this triangle. I really intend to buy a breakdown in copper, because I do believe that the chances are more tilted for a possible breakdown. Of course, nobody can exclude the possibility of a break higher, but I do like the fact that the move lower was more or less impulsive in nature. So I would want to see this break to the downside, and if that's the case, what would I acknowledge as a break down, having to do with where this trend line is now and the fact that we found twice support at 270. I would say that any daily close below 2.7 I'm going to take it as a confirmation that we're breaking out of it. So I think copper is one of those that you need to pay close attention to. Speaking of the ECB, and since we do have an ECB meeting, let's have a look at the bonds, and starting with the bonds in this case, because the bonds, and that should not be a surprise to anybody. I mentioned that the other day when we were testing, this area, the bonds, and I also wrote it to this is actually, I haven't touched my analysis since I did the weekend analysis. So as you see, the bonds were testing for multiple days this descending channel of resistance once again. And yesterday, actually, we got a nice move to the downside from here. Obviously, and this is what I wrote, if I remember right, with the end of week analysis. Obviously, the risk reward being very close to this resistance was to be short, and you can switch your position if we do get a daily close above 164, because a daily close above 164 is going to, first of all, produce a higher high after a very, very long period of time, and at the same time confirm a breakout from this descending formation. I do believe that this descending formation is a corrective formation. So I do believe that the chances are that this is going to be resolved to the upside, but that doesn't mean that it has to happen now, because you could assume the same thing here, you could assume the same thing here, you could assume the same thing here, and you would be mistaken every single time. So when you're so close to, to a support or resistance, you have to respect the risk reward. And if you want to do something, you either buy a confirmed breakout or you try to fade it, right? On a separate note, though, the fact that this descending channel was producing lower lows and lower highs for a long period of time, but we failed to do this in this case, is already showing me that this market is getting closer to that eventual break higher. Okay, because this is a change of behavior. It means that people that were actually bullish didn't even want to wait for a retest of this channel, because this is a very, very well defined channel. The market had already successfully tested it once, twice, 3 times, 4 times, 5 times, 6 times. So the bulls were more eager here. They didn't want to wait for a 7th test. They were content in buying it in previous support area above this this channel. Okay, which tells me that the market has already started looking higher. That does not mean, I repeat again, that we might not get rejected once more from here, but it tells me that the market is getting stronger within this consolidation. Okay, and this is something I keep in mind, and this is why I won't have much of a problem trusting a break higher, especially considering the fact that we're getting closer to a recession, because bonds getting bid and getting monetized again from central banks is going to be something that will eventually happen. Now, if it's going to end up working out, or we're going to get an initial move higher, and then perhaps inflation or something else is going to produce a completely opposite move where everybody has now turned once again bullish, then everybody finds themselves in the wrong side of the trade. That's another story, but it's not something that we need to consider yet. Now, having to do with the rejection from the previous highs in the treasuries, as I said the other day, I do see the probability of coming down, retesting this confluence of broken resistances as support, and perhaps producing another move to the upside. There is still obviously a bearish trend. Momentum has definitely shifted, though. I mean, momentum has completely stalled, and we have seen a very high RSI reading on the daily, which is roughly at 80, which usually points to a change in direction, even in the short to medium term. So I would be probably looking, if I was looking to do something in the short term, I would be probably looking as a higher probability of seeing that kind of a move first before seeing more weakness afterwards, if we're going to have more weakness afterwards. Okay, so I think this zone here is going to be a good zone for somebody. At least the risk reward is going to be great for somebody to try the long side once again. And that would also point to the possibility of more weakness in the stock market, right? That would also theoretically, I'm saying theoretically because as we were explaining yesterday, we haven't seen any follow through. That would also theoretically mean that there would be decent chances for the USD yen to produce at least one more move to the downside. But since the USD yen has been completely oblivious to anything else that's happening, I mean, its usual correlations either with the risk, bonds, or whatever else have broken down, I would just stay far away from it. Stelio, anything else that Draghi has given us from the Q&A? Because I do see that we're in the Q&A phase. So anything to consider here? Oh, okay. Yeah, he has already left. Again, I just didn't realize the time to pick up the kids. Okay, so I'm guessing nothing much.
Yeah, he left.
Yeah, so I'm really hoping that we're going to get some kind of a follow through after Draghi's press conference. As I said, if I had to bet, I would still be looking for more dollar strength, one last push of dollar strength. So I would be really looking forward to perhaps seeing a breakdown here in the Euro USD, a rejection from 127 for the cable, etc., and then to start looking actively to start shorting dollar within probably the next week or so. Coach, who did you say we have today for an interview? We have a question here from a friend. Hi, I'm a student in market analysis and would wish to sharpen my skills. Where should I start? You should start by
joining ForexAnalytix.
Yeah, that would be a good idea. But in general, besides that, you should start by finding the time frame. First of all, you should start by trading a demo account.
Or micros.
Yes, exactly. You should establish some strict rules in what you're doing. You should start by realizing and the importance of money management. So you should start by studying on what money management is and establishing like rigid rules having to do with that. And then you should start experimenting with various types of analysis and see what works for you. But most importantly, you should arm yourself with a lot of patience, because that's not an easy and fast way to make money, right? How have you said it, Coach? What have you said? It's the hardest way to make fast money.
A tough way to make an easy buck.
Yeah, tough way to make an easy buck. Yeah, exactly that. Yes, exactly. So who do we have today for an interview, Coach?
Larry Benedict. And he was written about by Jack Schwager in Market Wizards too, and he's in the house.
Amazing. And okay, perfect. So that's going to be a very interesting interview then, because Jack Schwager only mentions the best of the best. So and if any of you hasn't read any of the Market Wizard books, I strongly suggest that you do so. Strongly suggest. There are a lot of lessons, mostly, by reading the Market Wizards, I have to say that you can really get confused about what works and what doesn't work in the markets. You're going to see very successful traders making profit from totally different types of from using totally different trading styles, time horizons, market approach. Others are fundamentalists, others are purely technical traders, etc. But you're going to see that they have two things in common, all of them. They understand very well money management, market psychology, okay, and they do know very well when they write and try to make the best out of it when they're positioned properly in the markets, and they do admit when they're wrong very early and cut their losses short. I don't know.
I
if you agree
forgot
with
who
me,
the
Coach.
wizard was, but one of them said, which is kind of counterintuitive to everything that most people learn. He said you also have to know when to break your rules. I forgot who it was.
Yes, in essence, that transforms to a third value that you find commonly among great traders. It's not as required as the other two, which is indirectly you're referring to flexibility, Coach. So an amount of flexibility is also required, right?
Yeah. Take yoga before you trade. And anyway, Larry is here, Steve. Great.
Enjoy the interview. I'm gonna stay to listen on.
Okay, very good coverage of the ECB. Hi, Larry. I see you in the house. I'm going to make you the panelist so that we could hear your voice, and then I'm going to take the screen so I could show your website. Okay, so just wait a second. Make presenter, show my screen, and here we go. What a team. I've spoken to many of your experts, Larry. How are you?
I'm very well. Thanks for having us on. I appreciate it.
Yeah, it's great to meet you. I've read, your bio and a little bit about your history. What's interesting to me, Larry, would you prefer I call you Lawrence? Is it Larry okay?
Definitely. You could call me Larry, or you can call me Benny, which is basically a name that people knew me in the business for about 25 years. And I used to do a ton of business on the floor, and I would go.
Was that your badge?
No, it was my nickname for Benedict. Everyone called me Benny, but many people did business with me, and they'd say, "Oh, Larry's on the phone," and they wouldn't even know who that was. It was really kind of funny. So you call me Larry, but anyway.
All right, Larry. All right, so you've achieved a lot of great things, especially being written up by Jack. But I'd like to take you back to how you got in the business and what you may have been doing beforehand. Maybe, your whole life has been involved in markets, but why don't you take us back to the genesis of your career in the markets?
It started in 1984. I was at Syracuse University, and I went out to Chicago and had a friend there, and they took me to the exchange, and they were trading soybeans, and I went on to trade. Yes, and I went down to the floor, and I was a senior, 21 years old, and I saw what was going on, which no one could even understand because it doesn't exist like that anymore, which is kind of sad in a way.
Yeah.
But I saw that, and I said, whatever is going on here, I want to learn it, and I want to do it. And I spoke to the gentleman who was the trader, and he said, this was 1984. He said, I haven't really made money since the 70s. Big money. I think you should go learn options and go to the equity markets. And when I started, the Dow was, people are freaking out when it goes to like 23,000. It was 900 when I started. Right. So, I went to the floor. I went to the floor of the CBOE, and I was a clerk, a runner, and started from the ground up, and traded my own money for a bit, and then worked for a clearing firm that backed traders for a while, and then in the 90s, 1989, I went to Spear, Leeds and Kellogg, which was, I don't know if you're familiar with the firm.
I remember it.
Yeah, we were the largest specialist on the floor of all exchanges. We were a huge clearing business, and I worked there for 11 years as a prop trader, ran index derivatives for them, and the business was sold in 2000 to Goldman Sachs, and then I left there and set up a hedge fund that ran successfully for 13 years and to the outside.
Wow.
And, that's sort of the career. There were a lot of bumps in the road, but,
sure.
It worked out.
We had a similar experience, and I'm sure there's multitudes did. I went to the CME and I was up in the gallery and watched the belly market go fast market, everyone screaming, going crazy, and a friend of mine signed me onto the floor as a guest, and I went from brokerage house to brokerage house, said the same thing. I really don't care what you pay me. I want to learn. And really a great place, and you and I both, have fond memories and wish it existed for people coming into the business now. Most of the exchanges have become bowling alleys, except for the options pits. All right, so that's how it started for you. Who were your biggest influences? Were there any books or mentors, or are you pretty much self-taught?
Well, there were mentors along the way. No one that, is really known to the outside world. Okay. People that were at Spear Leads, that I reported to, very, very good traders. A guy named Randy Dorfman, very good trader at Spear Leads, as well as Larry Lavecchio. They taught me discipline, and, I sort of had what it took to really be successful, but it was really learning how to, I guess, bottle it up and stay disciplined, to be able to, take risk, calculated risk, and make money. And, that took a bit of time. That took probably 3 to 4 years. And it makes me laugh in the marketplace of online education, which, we're, attempting at this point, we're 6 months in, to give to people in a different way. How people say how easy it is, and you can turn $20,000 into $2 million. And
Larry, I've interviewed almost 1,000 traders, educators, analysts over the years, and I asked that question: how many years did it take? So you beat me to the punch to make a breakthrough and become consistent in the market, at least more consistent to when, you felt like you had it. You had a paradigm that was working for you. So that's interesting. It confirms what I've been hearing for a long time. You and I had a little conversation on the phone. Yes, people still do have conversations on the phone. They don't just text. And I think it was during a pretty good down day, and they were bringing the market back. And you were talking about how the markets have changed, because of central planning and, interventions in the markets. How have you adjusted to, a lot of guys made a fortune in open outcry because they didn't even have to know how to trade. They just traded off the paper. They knew where the stops were. They'd get long into the buy stops and use that liquidity to take profits or reverse. How did you make the adjustment from the floor to sitting in front of your screen every day?
Well, I kind of got lucky in a way. I was on the floor, and I was trading.
You were at SIBO, right?
I was in SIBO, and then I went back to New York in '87, and
that was a good year.
Yeah, that was a fun day to be on the floor. I was actually on the floor of the New York that day. It was awesome. I
had an office in Phoenix, a penthouse office, and my bank was downstairs, and I went down to see if the banks were still open. So anyway, they didn't even know.
Listen, I gotta be honest with you. The same thing happened in '08. Yeah. I had about $900 million in my hedge fund at the time, and we were, clearing at Goldman Sachs and UBS, and basically Goldman had to become a bank and demutualize because everybody was pulling their money, and we were freaking out. So it was the same type of thing. We were doing well, and
wanted to make sure that you could get return of capital, not just return on capital. So would you consider yourself more of a market technician or fundamentals? What's the mix or blend of how you look at it?
I would say the technicals are in my mind, you know, and I'm always looking at charts on a longer term basis, but I would say a little bit more fundamental, but really, you know, short term alpha trading. So doing a lot of transactions in a day, testing the market, doing a lot of options. Options are integral in what I do, both for hedging and enhancing return. It's worked for me well. But getting back to what you said before, what was interesting for me was when I was on the floor, I was trading S&Ps over the phone. So for me, I was lucky enough to make that transformation. But what happened to a lot of my friends and a lot of locals, as you know, they couldn't do it and they waited too long and it was game over. But you know, for my trading, it's short term, a lot of trades, a little bit technical, you know, some fundamentals, but really market action, you know, markets against other markets, looking at, you know, Europe and Asia and all these other clues.
So correlation work is a big part of it, trying to put the jigsaw puzzle together.
Yes, and you know, it's become a lot harder over the last couple of years, only because the algorithms have come in and they've thrown wrenches into what, you know, you would look at as a pure setup, and it's almost like a pure setup the other way. So they set it a certain way and then they turn the table on you. So you have to, you know, when you say adapt, we're adapting every day. We're watching, you know, different things that make the market move, and you know, we're in an interesting time now because I think the algos are getting chewed up, and it may be time for you know, some actual people out there to, you know, capitalize on this.
Yeah, well, maybe they should get rid of decimalization and go back to fractions and have some human beings in there that have the incentive to fill, so they could make some money on the spread. When the robots go crazy, you would have some human being backstops.
Right, and that's the hardest thing to look at. So when you were trading in fractions, you were trading in teenies or sixteenths, you know, and eighths, and you knew what you were trading for. There was you didn't. Now when you go in, especially on equities, you don't know if you're trading for a penny, 3 pennies. You don't know if you're going to get filled at 6 pennies. You have no idea. So it's really hard to gauge in sizing of the position and where you can get filled, you know, on the equities. I mean, the futures markets are really, really efficient. I mean, the S&P is, you know, minimum tick, whatever you need to do. But, you know, as we're moving, it's very difficult to execute because the algo, you know, sees your order before it hits the exchange.
Okay, well, you know, I confess I did not read Market Wizards 2. What was Jack interested in learning from you? And why did he choose you to be included in such an elite group?
I think he was introduced to me through somebody that was at Soros, who had money with me at the time. And, you know, we went through a period of 12 or 13 years with our biggest drawdown being 5% peak to trough.
That's amazing.
And having no down years and basically just grinding it out year in and year out, you know, on big capital, you know, the lowest capital probably a few $100 million up to $1 billion. So, you know, I think that's why he was intrigued by it, and he sat with me for close to a week and watched me trade and interviewed me and spent time with me and sort of got an understanding of how I do it, which in a way is a lot different than a lot of guys that are
in what way? In what way?
Well, I'm more of a counter trend mean reversion guy. And
you're like Paul Tudor Jones, all the big money's made at the turns.
Right. So, but Paul might sit for a long time. I'm in and out inside the trend multiple times, and I'll counter trend inside. You know, we might have a downtrend, and I might think that the market looks okay for a bounce, and you know, get long it for 15 S&P handles, and that's a good trade for me. So
you use divergence. What tells you that you're near reaction points in the market?
Well, you know, a lot of stuff I look at is option volatility, looking at option pricing. So really options are cueing me in. And then, looking at markets, it's been a lot more divergence in the last couple of years. What used to work for us like a charm is mean reversion between international markets and the US. And obviously, if you're looking at that this year and you tried to play that, you're getting hammered. So, but that worked really well for 5, 6, 7 years. So we would run, divergence to the mean off of other markets. So, if the DAX was up 11% and we were up 7, we may short DAX and buy US and, catch the, the turn back. And, those markets mean reverted and, most years ended up plus or minus 2% from each other. But, in fact, if you did that this year, you have the DAX down a smooth 15 and we're basically flat. So
emerging markets, if you're doing the weakness because of dollar strength. Do you pay attention, since currencies are bailiwick, and it's my belief that it's really the fulcrum of what most of all markets spin around, the value of the dollar, since it's the reserve currency? You pay attention to currencies?
Sure, I look at currencies, but it's hard on a short-term basis.
Okay, so let's look ahead then into 2019. You have a view on the dollar?
Yeah, I think everybody's dollar bullish, which was the opposite view of the year before, and I would tend to think that we're probably going to be dollar bullish first quarter of the year and then go the other way for the rest of the year, potentially.
Okay, so
That's
and
my
you think.
thought.
All right. I mean, look, here's a disclaimer. Past performance is not indicative of future results. You think that will peak underneath the Dixie 104 level from a year ago in the first quarter, or take it out? Do you have a vibe on it?
No, you know what? I don't. But it could.
That's cool.
It could get down in there. I mean, to be honest with you, the dollar is not my expertise in any way. I do trade currencies against the dollar on occasion.
Okay.
It's been less and less a focus. I used
anything
to
in commodities, Larry, that you pay attention to?
Yeah, I trade crude and gold and, obviously watch everything. I saw the natural gas move. We didn't participate in that, although I don't know if you saw on my site at the Opportunistic Trader, I have Mark Fisher. I don't know if you know Mark.
I have. If you can see, I have all your team up here. You have a massive team. Are they all in your chat rooms and come and work with people? I've interviewed Bryn and
Bryn is in our chat every day, and she also does multiple webinars. And I'm sorry, who else do you know?
Bryn and Tracy. I've interviewed Dave Floyd, Angie Setzer. She's great with ags. So it looks like you found the best of the best in a lot of different segments of the market.
Yeah, I mean, that's what we tried to do. That was my plan, is to put together a product at the Opportunistic Trader that not only potentially gives our trades, but gives you an opportunity to learn from Bryn, who is, very, very talented in the oil and electricity markets. And, obviously, Tracy's great. And, but Mark Fisher is, legendary. I mean, he's just made so much P&L in his career, and he's been trading since he's 19 years old. And wow. I've known him, since I'm 22, and I've watched the amount of money and how well he's done, and to get that information from him is pretty unbelievable. And if you go back and look pre this natural gas move, he was all over it before it moved. And, to me, to provide that information or, analysis to the public is something that you're not getting. I mean, he comes on CNBC maybe once or twice a quarter, maybe, but you get him on my site twice a week. So
nice.
Yeah, okay. So I think, that was a lot of what I am looking to do here, is to provide great information to help people navigate the markets and make money.
What's the, I asked Jack this question, what's the most important thing that you can tell traders, new, been around for a while, whatever? And he said, find a trading style that suits your personality. What would Larry Benedict say?
I would say that understanding risk is the most important thing to trading. Sizing of positions and understanding how to handle swings and being able to come back from numbers. So for us, it was always and is always that if you don't get down a lot, you're gonna see the balls. So I would say my advice is to, stay small and grind it out. And that's, what we do every single day. I'm a
Dale
grinder.
Pinkert wrote a song, Use Less Leverage. So you could find it on the internet. Larry, really a pleasure meeting you, and people could follow you at Opportunistic Trader with a 1 after it on Twitter. And this is your website, www.opportunistictrader.com.
Yes.
What do you offer as far as trades? You have a chat room, a trading room?
Yeah, we have. I give out all the trades that I do, as well as a couple other people in the community, in our expert community, and we have a chat room going all day with multiple rooms. We have a currency, we have a commodity, we have an equity, and we have a general room, so you can camp out there. And then all day long, we are getting experts in different markets and different landscapes to give webinars. I think we have Bryn on today, actually, as well as 3 or 4 other people in different spaces. So we provide educational webinars and informational webinars around the chat room as well.
Okay, Larry. Well, great meeting you. I wish you and your team, and all the people who read your stuff, that pips are like snowflakes in a blizzard on top of all of them, that they have a Merry Christmas and a Happy New Year and a great trading year in 2019 ahead of us. So you're now my trading warrior brother, like it or not, Larry.
I like it. So I look forward to speaking more, and I appreciate you having me on today.
You're very welcome. Everybody, Larry Benedict, you could follow him on Twitter at Opportunistic Trader 1, and go to his website. You'll see a lot of great analysis there. And that's a wrap for us for today. And really, everyone remember this. Don't just count your pips, count your blessings. We'll see everyone to wrap up the week tomorrow. Larry Benedict, Market Wizard, thank you for being with us today. And we'll see everyone tomorrow. Adios.
Thank you very much.
You're welcome, buddy.
Bye.
Bye-bye.